Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, May 12th, 2026, and markets are on edge ahead of today's inflation data release, while geopolitical tensions continue to push oil above the $100 mark. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is the market's positioning ahead of the CPI data that's coming out today. We're seeing futures pulling back with both the Nasdaq and S&P 500 declining as traders reduce risk exposure before these numbers hit. What's particularly notable is the dual pressure we're facing. The inflation uncertainty domestically combined with escalating Middle East tensions that have pushed oil prices above $100 per barrel due to the Iran situation, and what appears to be a stalemate in negotiations. This creates a challenging environment because higher oil prices feed directly into inflation expectations, which could complicate the Fed's policy outlook. On the corporate front, we're seeing significant activity with EQT submitting a final £10.6 billion bid for Intertek and SoftBank injecting $450 million into a British AI chip company, showing that strategic M&A and tech investment continues despite the uncertain macro backdrop. The UK situation is also worth monitoring closely, with Keir Starmer facing a leadership crisis that's actually rattling bond markets there, causing British government debt, currency and stocks to fall as borrowing costs surge, which shows how quickly political uncertainty can translate into financial market stress.
That's a concerning mix of factors. How are you reading the market's interpretation of these developments?
Markets are clearly in a defensive posture right now. The pullback in futures suggests traders aren't willing to add risk ahead of the inflation print, which is smart positioning given how sensitive equities have been to any inflation surprises over the past few years. What I'm watching closely is the energy sector's response to oil above $100. Interestingly, despite the war and elevated prices, energy stocks remain relatively cheap according to recent analysis, which suggests the market might be pricing in either a quick resolution or concerns about demand destruction at these price levels. The corporate earnings picture is mixed. We saw Hims and Hers plummet 16% on weak earnings and guidance, while On Holding beat expectations and is seeing double-digit growth in China, even as Nike lags, showing there's real divergence in how different companies are navigating the current environment. The private credit space is also cooling off after its hot streak, which indicates some of the frothier areas of finance are starting to normalize. For indices, let me give you the technical picture. The S&P 500 is testing support around its 20-day moving average, and if we break below that on a CPI surprise, we could see a move down to the 50-day around 4,800. The Nasdaq is showing more weakness given its tech concentration, currently sitting below key support at 15,000, and a breakdown could target 14,700. The Dow is actually holding up better, relatively speaking, supported by its value and dividend components, but it's still vulnerable if we get a hot inflation number that pressures rate cut expectations.
That selectivity across sectors and indices is definitely the story. What does this mean for traders positioning today?
For traders, today is all about risk management around the CPI release. If you're holding positions, you need to be prepared for volatility in either direction. A cooler than expected inflation print could trigger a relief rally, particularly in growth and tech stocks that have been under pressure, while a hot number could accelerate the selling we're seeing in futures. I'd be cautious about chasing any initial move because we've seen false breakouts in both directions recently. The energy sector presents an interesting opportunity if you believe oil stays elevated, but you need to be selective because not all energy names are created equal in this environment. The UK situation is worth monitoring because if political instability spreads, or if we see contagion into European markets, that could create additional headwinds for US equities through the global risk sentiment channel. On the M&A front, the EQT Intertek situation and the broader deal activity suggests that strategic buyers still see value, which is actually a positive signal for market fundamentals, even if near-term volatility remains elevated. Amazon's announcement about 30-minute delivery in dozens of US cities shows the retail competition is intensifying, which has implications for logistics and last-mile delivery stocks.
Those are solid insights for navigating today's session. Steve, let's get into the economic picture. What are the key data points we're dealing with?
Thanks, Robert. Today is absolutely critical from an economic calendar perspective because we're getting the April CPI report, which is the main event for markets this week. This inflation data will be scrutinized intensely because it directly impacts Federal Reserve policy expectations and the timing of any potential rate cuts that markets have been pricing in. The consensus is calling for a modest cooling in headline inflation, but any surprise in either direction will drive significant market movements given how sensitive positioning is right now. What makes today's number particularly important is the context we're seeing it in, with oil prices surging above $100 due to Middle East tensions, which raises questions about whether we'll see energy costs start feeding through into broader inflation measures in the coming months. Beyond today's CPI release, we need to keep in mind that we're in a period where every inflation data point carries outsized weight because the Fed has been very clear that they're data dependent and need to see sustained progress on inflation before considering any policy adjustments. The labor market data we received in previous weeks showed continued resilience, which means the Fed doesn't have an employment reason to cut rates aggressively, so inflation really becomes the determining factor for policy direction. Looking ahead to the rest of this week and into next week, we'll be getting retail sales data later this week, which will give us insight into consumer spending patterns and whether higher gas prices are starting to impact discretionary spending. The housing market data is also coming up with building permits and housing starts, which will show us how the residential construction sector is responding to the current interest rate environment.
How should we interpret the interplay between these inflation readings and the geopolitical energy price shock?
That's the key question right now. The challenge for policymakers and market participants is distinguishing between underlying inflation trends and temporary supply shocks from geopolitical events. The surge in oil prices we're seeing is clearly driven by Middle East tensions rather than fundamental supply and demand imbalances or overheating in the economy. However, if oil stays elevated for an extended period, it will feed through into transportation costs, goods prices, and eventually services inflation through second-round effects. The Fed will be watching closely to see whether this energy price spike causes inflation expectations to become unanchored, which is what they really want to avoid. The producer price data that typically follows CPI will also be important because it shows us pipeline inflation pressures before they hit consumers. We're also seeing interesting divergences globally, with Japan recently indicating that Treasury Secretary Bessent offered understanding on yen policy, which relates to currency movements and their inflation implications. The UK's situation with surging borrowing costs shows how quickly bond markets can reprice when there's uncertainty, and while the US isn't facing that kind of political instability, it's a reminder that fixed income markets are very sensitive to any shifts in the fiscal or policy outlook.
Lizzie, let's shift to crypto markets. What trends are you seeing heading into next week?
The crypto market is showing some really interesting divergence right now. Robert Bitcoin is in a cautiously bullish position after briefly touching $82,000 and establishing new psychological resistance levels. We're seeing positive funding rates which suggest renewed institutional interest, and there's potential for a rally toward 85,000. What's particularly notable technically is that Bitcoin is forming a golden cross pattern for the first time since 2023, which historically has been a strong bullish signal strategy, formerly MicroStrategy, resumed Bitcoin acquisitions with a $43 million purchase, and Michael Saylor has been actively defending their sales strategy, which shows continued institutional conviction. The floor appears to be firming around the $80,000 support level, though there's still some trader skepticism about whether this breakout is sustainable. We did see some selling pressure from miners, with Mara selling $1.5 billion worth of Bitcoin as they shift toward AI infrastructure, and Bhutan continues to reduce their state Bitcoin reserves, but overall the institutional accumulation story remains intact. For next week, I'd watch for that 85,000 resistance test with 80,000 as strong support, though the Coinbase premium remaining negative suggests retail investors are still hesitant.
And what about Ethereum and Solana?
Ethereum is facing headwinds right now with a bearish to neutral sentiment. The ETH to BTC ratio hit a 10-month low, showing significant underperformance, and price remains stuck below $2,400 resistance, with potential loss of the $2,200 support level. There's a bearish RSI divergence forming, which indicates weakening momentum. Tom Lee's Bitmine is slowing ETH purchases after accumulating 1 million tokens, which is a shift in their strategy. However, there are some positive institutional developments with Galaxy and SharpLink planning a $125 million DeFi yield fund backed by Ethereum Treasury, and Aave launched a binding Arbitrum vote to move 71 million in disputed ETH each. For next week, I'd be cautious on Ethereum, watching that 2200 support level closely because a break below could trigger further decline. The technical picture just isn't as strong as Bitcoin right now. Solana, on the other hand, is showing bullish momentum with SOL ETF inflows rising as traders eye a $120 rally target. The major catalyst here is the Alpenglow upgrade, which is the biggest consensus overhaul in Solana's history and has entered live validator testing. SOL rallied alongside Bitcoin's move to 82,000 but has been rebuffed from key levels recently. The $120 target based on ETF inflow momentum looks achievable if broader crypto sentiment remains positive. Overall, institutional activity is strongest in Bitcoin and Solana, while Ethereum faces near-term pressure despite the longer-term DeFi developments.
Well, that wraps up today's Morning Bell. We've covered a lot of ground, from inflation data and geopolitical tensions to crypto market divergences and corporate developments. Remember, do your own research and consult with financial advisors before making investment decisions. The markets are complex, and what we discuss here is for informational purposes only. If you found today's discussion valuable, please subscribe to the Morning Bell wherever you get your podcasts so you never miss an episode. Thanks for listening, and we'll see you tomorrow.